Hello and welcome to the Year Ahead special of Bondcast, podcast series where we discuss our views on the latest themes and events shaping rates market. I'm Imogen Bachra and I'm joined today by our global market specialists, Joann Spadigam and Brian Daingerfield. So as I said, this is our Year Ahead special version. We've just published our full 190-page report. Actually, by the time this is published, we will have published the full report last week, but I'm imagining not many of our clients will have got through the full 190 pages. So the podcast episode today, I guess, is designed to just give you a bit of a flavor of how we will be thinking about bond markets in the year ahead. So we titled our report this year The Policy Pendulum because we think that the next year, 2025, will be characterized by this policy pendulum swinging towards further fiscal activism, the path to terminal rates, and global protectionism. Of course, when we look forward to 2025, it's kind of hard to do that without also reflecting on 2024. And in many ways, we'll remember 2024 as the year of the ballot box. You know, more than half the world's population headed to the polls, and many incumbent governments fared relatively badly as still high prices and high interest rates weighed on living standards. This time last year, when we were writing our year ahead, we wrote that fiscal forever was on the ballot. And as we enter 2025, it's no longer just a campaign promise, but really the newly elected reality. You know, we're in an environment where government deficits have ballooned and any fiscal consolidation feels further away now than it ever has done. And really, I think the key theme for us across rates markets is that in 2025, it feels like fiscal rather than monetary policy is going to be in the driving seat. You know, we think yields across developed economies already this year, they're on pace to end the year higher than they started, which would be the third year out of the past four that happens. And we think that continues. You know, we've seen higher yields this year, despite the fact that 2024 has also been the year of the monetary policy pivot. And we see more of the same in 2025. What we've kind of coined fiscal's long COVID, we think will weigh on the outlier level of yields and on curves. Of course, the impact of all these elections this year, though, goes well beyond the yield curve. We're seeing geopolitical risk and protectionism that appear resurgent, challenging the resilience of supply chains, threatening escalation of global conflict, and raising the risk that inflation stays higher for longer. All of that is likely to weigh on central bank reaction functions next year. And so although we see, central banks reaching terminal rates in the first half of the year, we think that these level that they settle at will be much higher than they have been in previous cutting cycles. And I guess more importantly as well, we see very different landing zones across the region. So, whilst we see probably fewer elections in 2025, putting all of that together, it feels like markets are going to be no less volatile as they navigate this swing towards fiscal activism, terminal rates, and global protectionism in a post-election world. And it's all of that we're going to try and dig into in a little bit more detail in today's podcast. So perhaps let's start in the US. I know we're looking forward to 2025, but of course the elections are very much still front of our mind and front of markets' mind. So let's start there and just think, I guess, around, the risks to our inflation view next year and how do we see that impacting where terminal rates might get to in 2025 for the Fed.
Well, thanks very much for having me, Imogen. I think you hit the nail on the head here that the U.S. election just happened and Trump winning with united government has very significant implications for not just themes here in the U.S., but all of those themes, geopolitics, fiscal long COVID, terminal rates, both in the U.S. and globally. All of those, Trump has influence over all of those. And among the many factors that we're tracking here, a lot of them we think are leaning towards higher inflation, whether that be from additional fiscal stimulus via tax cuts in the new year, whether that be because of tariffs, increases in tariff related inflation, whether it be on goods from China or potentially global minimum tariff, though we think global minimum tariff perhaps a bit less likely to be actually come into effect. We think tariffs on imported goods from China are likely to come into effect early in the year next year, boosting inflation and inflation expectations as some of those higher prices feed through to consumer prices. When you take these two together, we think what that probably means is where the Fed ends its easing cycle in 2025 probably comes sooner and at a higher terminal rate than we previously thought. So just to put some numbers on that, before the U.S. election, when we were making our assumptions without a specific fiscal outcome baked into our projections, we thought it was possible that the Fed could be among the leaders in terms of monetary policy easing within the developed world, because you'd seen clear signs of progress on inflation, and you'd seen some moderation in the labor market, supply and demand coming back into better balance. But I think that Trump's victory and the possibility of new fiscal stimulus, new tariffs, possibility of inflation staying elevated for longer, I think that reduces the scope for the Fed to be a leader in the easing cycle and maybe pushes them more toward the latter end. So we think the Fed cuts the policy rate and ends their terminal rate is reached in the end of the first quarter of next year at a terminal rate of 3.75 to 4%, which would put the Fed funds rate among the highest in terms of terminal rates within the developed world. And so that has, I think, very important implications, of course, for interest rates, which is that the scope for Fed easing to move more aggressively, more confidently, and to push front-end yields lower is simply reduced in this sort of post-Trump environment. Now, I think the risk we'll be running into is the implementation risk around Trump. Certainly, the markets have repriced in a significant way already. Markets have already revised up expectations, ourselves included, for where the Fed funds rate ends this cycle. A lot of that is based on a market assumption of what Trump is proposing and how much really gets over the finish line. So investors are going to have to be very cautious and very, aware of where Trump is relative to his campaign promises. If he's over or under delivering, that could have very important implications for not just where monetary policy nets out in 2025, but also the implications for deficits and potential supply and demand concerns for the long end of the curve as we head into the back end of 2025.
I suppose switching gear a little bit and going to the UK, Imogen, the UK also has had a bit of an inflation problem this year. And the Bank of England has been quite focused on private sector wage growth. And clearly there's been a sizable fiscal stimulus package as well following the autumn budget. How are you seeing all of this in terms of where that leaves terminal rates and also your views on inflation for next year?
Yeah, it's interesting actually when we talk about our view on terminal rates in the UK, because for the first time in a long time, our base case scenario of reaching 4% by May is actually a little bit more dovish than what the market is pricing in. So the market is pricing in the BOE settling at a higher rate, at least by May of next year. But actually, I would say that's not really a view that's reflected in many of our client conversations. So still, when we speak to clients, it sounds like we are at the more hawkish end of expectations. Most of them see a terminal rate in the UK at a top end of 3.5%, I would say, if not lower. And that was also reflected in a client survey that we did before writing the year ahead. And some of those answers were collected ahead of the budget, and some of them were collected afterwards. But even in those ones that were collected afterwards, after that fiscal stimulus had been announced, they still didn't have, on average, they still saw a terminal rate of sort of 3.25% to 3.5%. So despite the fact that market pricing has moved a long way in recent weeks, and has moved more than, or to a higher level than we're expecting, that isn't necessarily what we're hearing from a lot of our Conversations. But yes, the short answer is that actually we haven't changed our view that we think that terminal rates in the UK can settle at 4%. A lot of the pushback that we get around that view is, as you've just heard Brian say, we kind of think 4% might be the upper bound for the Federal Reserve next year as well. And often people question why we would have such a high terminal rate in the UK, and why that would need to be the same level that it is in the US. But as you rightly identify, I think there's a couple of justifications for that. The first being this fiscal impulse that's been announced. The Labour government has just announced a huge fiscal stimulus, one that's larger than we had expected and much larger than the market had been expecting. And I think there's probably an undeniably, at least near-term inflationary impact from that. And you see that in the official forecast as well. The Bank of England and the OBR both revised up their projections in the near term for inflation. We still have this ongoing stickiness in domestic price pressures. Just this week, service price inflation printed again at 5%, a level that's not really consistent with the Bank of England meeting 2% on a sustained basis. As you say, wage inflation is very high. We still have this ongoing stickiness in the labour market. And there's an argument to be made, perhaps, that the government's decision to raise the employer's national insurance contribution might ultimately cut the extent to which wage inflation can remain high. But of course, on the public side, you still have sizable public sector wage rises. And we don't think we've seen all of those come through yet. We think there could be more public sector wage rises to come. And so what does that tell us about the UK economy? I think when you look at these, the domestic price pressures that we are generating, you can just see that there is bigger evidence of supply side impairments in the UK. It's a sort of post-Brexit, post-pandemic issue that we can see by the fact that the UK, for all that growth has outperformed, at least in the first half of this year, the UK still hasn't exactly been booming. And so for every unit of growth the UK has been generating, we've just been generating much higher inflationary pressures. And it's those domestic inflationary pressures that we think will require the BOE to be a bit more forceful, at least through 2025. So we have them cutting three times at 25 basis points next year to get the bank rate back down to 4% by May. I think the risks to that are probably skewed closer to market pricing. So you reach that 4% level, but maybe closer towards the back end of the next year, rather than anything sooner. What about in the euro area, Joann? I mean, I think you could argue that inflation has been better behaved in the euro area than what we've seen in the UK and in the US. How does that leave, I guess, your view on terminal rates, and how do you think the risks are skewed versus our baseline on the macro outlook?
So, as I said, I think it's been a pretty interesting year in the sense that the European data, in contrast to the US data, has essentially come in line with expectations. So, I mean, even if we look at what we thought about at the end of last year and think about what we're looking at the end of this year, I think the narrative has still very much stayed on track. Inflation in the euro area is normalizing at a fairly good pace. And we think that normalization process does continue. And various forward-looking measures, for example, on wage inflation and such, do suggest that inflationary pressure is coming off in Europe. I think similarly on the growth side of Europe, the ECB clearly is concerned about downside risk to growth in this context. I think that our key scenario for next year is that we do get an increase or an improvement in growth over next year that is really coming from the consumption side of the economy. I would say that in terms of Europe, the risks to me are more skewed to the downside. So we see terminal rates at 2%, and that's really based on this idea that inflation does normalize and that growth does pick up next year. But I think if we're thinking about risk, to me, the risk really is that our growth outlook, so an improvement in growth next year, does not materialize. And I think that with that will bring downside risk to our expectations of terminal rate, which is currently at 2%.
I guess the differing outlooks for growth is quite important because clearly, the euro area has suffered through 2024. And at the same time, we've had US data that has kind of, beaten after beaten after beaten versus consensus estimates. So, Brian, do you think this kind of US exceptionalism narrative will still hold into 2025? Will this kind of ongoing strength in the labour market, strength in the GDP data continue? And is there any impact of Trump's potential policy measures that might push you more in one direction or the other?
Sure. So I think it's pretty clear that over the last few years, the U.S. economy has continued to defy expectations, as you mentioned. But with that being said, you have seen a meaningful downturn in labor demand, not so much in terms of labor supply. You've seen the labor market come back into better balance, and you've seen inflation come down materially. And so I think the market has certainly got themselves much more into a camp of soft landing being the broad expectation. And it feels like, the data have been pushing in that direction as well. Certainly the most recent data have outperformed. And so when we're thinking about growth next year and how Trump and potential stimulus impacts that, remember there's a sequencing issue to consider, which is that fiscal stimulus via tax cuts, we're probably talking about middle of next year for implementation for fiscal year 2026. So even though there is potential stimulus coming, we're probably not thinking about that as a near-term boost to actual delivered growth. Of course, expectations certainly feed in, and we've seen that in markets. We've seen it in financial conditions. But in terms of when is the stimulus delivered, we probably have a bit of a runway here before that stimulus gets delivered. At the same time, the market should, I think, really be considering tariff risk, and how that relates to U.S. growth as compared to global growth. Because in the first term, when Trump pursued the trade war in his first term, that was seen as widening growth differentials further in favor of the U.S. Well, I believe that's still the consensus now. I think we're in a different inflationary backdrop than we were at the time, and markets, of course, will be judging whether or not corporates and businesses are able to effectively pass through cost increases onto a very price-weary consumer. And so we still think that growth next year in the U.S. can downshift a bit. But frankly, we've been wrong before, and we could absolutely be wrong again. I mean, this consumer has shown incredible resilience. And there are a number of theories why that could be, whether it be, the market collectively misjudging the amount of excess savings in the economy, sort of the post-COVID savings accumulation, whether that's a factor of elevated asset prices, giving consumers more confidence in their personal position. Same with the labor market. But stronger consumption and better domestic economic performance. It's not just a U.S. story, although U.S. has by far been the strongest of these economies. It's also been the case, I think it's fair to say, in the UK and the Euro area as well. So it's not just a U.S. story that the consumer, I think, is held in better. But we do think that the U.S. does downshift a bit further next year. But Trump introduces so many risks on both sides at this coin, right? Because, Joann, you just talked about the possibility of internal growth expectations in the Euro area, maybe looking a little bit better. Trump introduces significant external risks to that outlook. And not just for the Euro area in the UK, but for China as well. You think about China as large economy, already facing internal challenges. Now we're adding on layers of external challenge. And so U.S. exceptionalism, I think, is a theme that's ebbing over time. That U.S. is we continue to think the U.S. economy slows, but this has been an economy that's outperformed in the past. And I think we have to be mindful and accepting of that risk that this U.S. consumer has shown a lot more runway and could continue to do so.
Yeah, it's like the recession that never happened, right? Everyone's been calling for a US recession for so long and just had to push back those projections. And I think you raised an important point when it comes to the global GDP hit. We have in our year ahead, we've put 2.5% or 2.75% as our sort of global growth forecast, which isn't especially subdued versus the last couple of years, but it is subdued versus previous cycle averages. And a large part of that is this weight of global protectionism that, clearly hits, the impact of these tariffs will go well beyond just the US or even just the Euro area. Okay. So thinking about the Euro area and that growth hit then, because of course, we talk a lot on this podcast about the Euro area in aggregate, but actually the makeup of the growth in the Euro area has shifted quite a lot in 2024. We've obviously had, Germany that was once the pillar of growth and stability, I guess, in the Euro area and the southern countries being the kind of weaker link. And that seems to have evolved. This sort of north-south shift has happened a little bit in 2024. How do you see that either extending or reversing into 2025, Joe? Do you think, is there a more optimistic outlook for the growth picture in Germany or actually do you think peripheral countries like Italy and Spain continue to outperform?
Yeah, I think that's a great question because I think Germany really seems to have been in the news for the wrong reasons this year. Volkswagen, for example, laying off workers and shutting down factories, and a fairly stagnant picture for growth as well. I mean, I do think that in general for the Euro area next year, we do expect that pickup to come on the consumption side. But as Brian said, there clearly are risks exactly with a Trump presidency and what exactly the tariff impact will be. I think in terms of Germany, if we're thinking about asymmetric impacts, for example, from a Trump presidency, Germany would be hit a little bit more, for example, versus countries like Italy. But I do think, Trump risks aside, I definitely think that the case for an outperformance in countries like Spain and Italy will continue into next year with just a much more robust picture for growth and spending there. I think what we've also seen in the market for this year is that spread, so the difference between,
10-year rates in Italy, for example, and 10-year rates in Germany have compressed quite a lot. I think that that's supported by the risk environment and the fact that, we do expect that soft landing to continue and that soft landing narrative to continue in Europe. So I think that spread compression story that stems from the soft landing will continue next year. But I also think what's important is I think there's a bit of a reassessment in the market of Germany's status as a safe haven and a driver of European growth. Clearly that's not the case anymore with Germany's quite stagnant economy and a stagnant manufacturing sector. But I also think if we think about things like political stability, Germany in the past was also the beacon of political stability in Europe. And that's changed a little bit in the past, with even Italy's Meloni becoming and seeming a little bit more market friendly. The ECB has various tools like TPI, for example, so the transmission protection instrument, which does help to ensure that spreads stay contained. And then, of course, I think there's things like EU breakup risks, which aren't really a factor anymore. So I think on a lot of metrics, the safe haven status of Germany has changed and does make it a bit of a weaker link, I would say, in a bit something that we could expect to drive this outperformance of other countries like Spain and Italy versus Germany. I think that the last thing to say on that is Germany, of course, in terms of their debt metrics, has remained gold standard. But I think that perhaps might be to the detriment of Germany versus the strength there. So I definitely think that there's positivities to come or positive outcomes to come if Germany does spend more as well, which would help the euro area as a whole and also help structural issues within Germany. I suppose to wrap up our discussion on growth a little bit. So Imogen, in the UK, growth has also been fairly weak over 2024. How do you think that that moves into 2025? Do you see continued weakness? Do you see a pickup there? And I suppose relatedly, how do you think that the labour market will move, given that there's also been some announcements from the autumn budget on the increase in national insurance contributions for employers as well?
We have, I guess, quite tepid growth forecast in the UK. We have 1.2% in 2025, which I think is actually also what you have in the euro area, Joann, and then a very small pickup to 1.3% in 2026, both of which are broadly in line with our kind of trend estimate of growth of about 1.25%. I get, like Brian was saying for the US, I guess there's kind of competing forces when it comes to UK growth. You have this temporary fiscal boost, but then that's probably offset by what we predict to be declining private sector investment. Of course, that's partially a result of tax rises. The UK has essentially its highest tax burden since World War II now. And of course, that risks crowding out any private sector-led investment, private sector-led growth. And we still see quite cautious demand into 2025. We still have this kind of de facto monetary tightening, not because bank rate isn't going to be cut, but because of the structure of the mortgage market in the UK. Of course, if you fixed it in 2020, 2021 at very low interest rates, and you fixed for 5 years, which was really when we saw the bulk of the kind of extension of mortgages from 2 years to 5 years. Of course, you're only just about to roll off onto a significantly higher rate. So even though that rate isn't perhaps as high as it could have been, rolling off from 1% to 4.5% is still quite a significant hit to your disposable income. So we think that there is a sort of ongoing drag on the consumer next year as well. And the combination of those things will keep growth relatively tepid at 1.2%. I think fundamentally you would describe growth in the UK as being constrained by impaired supply. We have this, as I spoke about before when I was talking about inflation, we have this ongoing tightness in the labour market, which is partly about the fact that we have this very high levels of inactivity or low levels of participation. And we have this depleted capital stock because business investment has been so low for such a long time in the UK. And we have quite anemic underlying productivity, despite the fact that the government has just announced all of these investment spending measures. The OBR doesn't predict any of those or project any of those to actually add to growth before the end of the forecast period. So the growth outlook is
is somewhat bleak in the UK. But I think when we think about rates, the Bank of England is going to be much more focused on inflation than perhaps you might see the euro area, for example, who might be maybe or has been a bit more concerned about the growth outlook. Okay, so we've talked a lot, I guess, in terms of setting the scene from an inflation perspective, from a growth perspective. And I think all three of us have mentioned quite a few times the fiscal stimulus that's coming or, in the pipeline. So let's think about what that really means for markets. I think we, as a house, are maybe a bit more concerned, or certainly we have been a bit more concerned about the fiscal pressures and what that might mean for the level of yield, the shape of the curve next year. When we look at the forward pricing in the market, when we look at the results of our investor survey, it feels like our year-end 2025 yield targets are quite elevated. We think that we still haven't seen the peak in gilt yields, for example. We see that at 4.75% in the 10-year. We think we haven't seen the peak recently in US yields either. Again, we have that at 4.7% by the end of the year. And we see 2.6% in 10-year bonds. And, it's this kind of weight of fiscal policy or the weight of supply that is driving those views. So let's dig a little bit into those views now.
So Imogen, you are the most bearish of the lot with a 4.75% target on gilt yields. You're quite bearish going into the October budget and even more bearish going into next year. So what's driving that bearish view, I suppose? And do you think that supply narrative is well priced at this stage?
Yes. I mean, and sort of repeating myself here, but it comes down to this fiscal policy view. There's a supply demand imbalance in the UK. And I think that, there's sort of gilts are going to require an ongoing cheapening in the clearing price in order for all of this supply to be absorbed. We get a lot of pushback on this sort of bearish gilt view. A lot of people think they look cheap already. And of course, if you look on a chart historically, then gilt yields are, close to record highs. If you look at them cross market versus the euro area, especially, that yield spread looks very, very wide. So it's difficult to deny that they're not at high levels or cheap levels. But I think that is justified by this fiscal position. And the two pushbacks that we really get are, A, is this bad news not already in the price? We all know that supply is going to be high. We've had the October budget, which confirmed that. So how much further do they really have to run? So that I would say, I think that there is a flows effect to supply just as much as there is an announcement effect. So we've kind of had the impact from the announcement effect after the budget. And now there is this, like I say, ongoing cheapening in the clearing price that has to occur for these auctions and the syndications, sort of week in, week out to actually be absorbed by the market. And the second point is, or the second pushback that we get frequently is that, why is this such an issue in the UK? You look at the US with a 6% deficit and, upside risks and, a 6% deficit into perpetuity, essentially. There's no sign of fiscal consolidation there. And of course, the borrowing numbers in absolute terms in the US are much larger as well. But for me, it's a sort of relative narrative in the UK. When we look at how much supply has increased, so when you look at net supply and you strip out redemptions and you take out quantitative easing or you add back in quantitative tightening, what we can see is that since that 2015, 2019 kind of pre-COVID period, issuance in 2024 and 2025 in the UK will be 7 times larger than it was pre-COVID. 7 times larger. That's a huge increase for a very small market. Whereas the US is only going to be about twice as large. And of course, you could argue that risks are skewed to the upside there as well. But certainly not to as high as 7 times as large. You also have the added fact that, I think the fiscal position from a debt servicing cost perspective looks a bit more precarious in the UK. Interest expense as a percentage of GDP is now at 4% in the UK. It's more than doubled since pre-COVID. And again, it's higher than the US, despite the fact that, the deficit and borrowing is much larger there. And my favorite fun fact, I would say, in the year ahead period is that means that, the Europeans' old excessive deficit procedures that said that you weren't allowed to have a deficit of more than 3%. the UK's debt servicing costs alone would be enough to push them into an EDP. So, quite high, really. And the final point I would make about why this is a uniquely bad scenario in the UK is just that it's not just about the supply side, but also that we've had big structural shifts on the demand side. You've lost price insensitive buyers like the Bank of England and to a large extent pension funds. And we've replaced those with demand from domestic bank treasuries, with overseas demand. But some of that is just much more price sensitive and focused much more at the front end of the curve than that lost demand is. I'm still of the view that, we haven't seen the peak in gilt yields, certainly around the 10-year point of the curve. We think that that's the underperformer on the curve, if you like. And there could be higher yields still from here to come. But of course, it isn't all about the UK. This is a global narrative, I should say. And like I said, on the surface, you probably wouldn't be misplaced worrying a bit more about the US, given just how elevated those deficits are, and just how, the risks are skewed seemingly, it feels like, one way. So, Brian, how does that impact where you see, the level of rates and yields next year, and how you think about the demand and supply of treasuries?
Yeah. So, we face in some way similar issues, in some way very different issues than the UK. I think the similarity is that the scope of fiscal stimulus that could be coming from the new administration is quite significant, because you're looking at potential for significant expansion of stimulus via tax cuts and revenue offsets that are really lacking. Tariff-related revenue is unlikely going to be enough to cover for additional fiscal stimulus. And so, in a lot of ways, I think we're flying blind as far as how much actual fiscal stimulus gets over the finish line, how much revenue ultimately comes in on the other side, because translating Trump's policies, his campaign rhetoric into actual policy is one that's going to be quite uncertain. But the potential upside to deficits could be quite significant. And that's only including tax cut legislation. You're not even including something like mass deportation plan, which could also be a quite significant spend, and other options, additional spending, whether it be, another push on infrastructure, which is something that's not really being talked about right now, but is potentially within the realm of possibility under a president with united government. So the scale of potential additional deficits here in the U.S. is quite large. Perhaps the biggest difference, the most important difference, and probably the biggest pushback we would get against having a more bearish view in long end rates is because of this demand for U.S. Treasuries, that because the U.S. is the world's reserve currency, largest, deepest, most liquid market, that there is just inherent demand for U.S. Treasuries at all points on the curve that just doesn't exist in other smaller economies. And so therefore investors may not be as price sensitive. And we hear those, we certainly hear that. But we do feel like that the scale of fiscal stimulus that is to come, could be quite significant. And we think, we'll be watching very closely both term premium and inflation expectations, because if we just assume that China tariffs come into effect and none of the global minimum tariff come into effect, you could still be looking at inflation that's almost 1% higher in 2025 than it was in 2024. So in terms of inflation expectations, plug your ears if you were in the market in 2020, 2021. You could argue that inflation impacts are transitory because they are a one-time increase in prices because of changes in tariff levels. But we are looking at a backdrop where inflation is likely to be higher next year because of tariffs. Growth, we'll see what the risk reward is around growth because of fiscal stimulus, but deficits could be a lot higher, inflation expectations a lot higher. And with all of that, the possibility of higher term premium, I think, exists as well, underlying this movement. So, in a lot of ways, Trump's win and the change in fiscal policy has left a lot of uncertainty. But we feel like it's right that investors should be approaching the long end cautiously here as we think about trying to translate these issues. But perhaps the most important difference is this question of U.S. demand. We don't think the U.S. necessarily loses, its status as global reserve currency, as global safe haven. That's a positive for treasuries relative to other markets. But that doesn't mean that all investors will be price insensitive at all points, right? So we think that is a risk that markets should remain mindful of when we're thinking about a rates higher for longer environment from the Fed, but also this additional fiscal stimulus.
Yeah, definitely. And Of course, Joann, the problem feels a bit less acute in the euro area, but that doesn't mean that we won't still have another year of very heavy supply. So do you expect that demand will keep pace for supply of European government bonds in 2025?
Yeah, so I mean, I think similar to the rest of the world, there's quite a lot of supply coming in Europe next year. I think that the difference in Europe, I suppose, is that there has been some form of fiscal consolidation. And the fact that we've got this European excessive deficit procedure does help to keep some countries that would like to spend more a bit more on track and a bit more into the deficit reduction mode. So there is some fiscal consolidation, but the amount of or the impact on the amount of growth supply for next year that is coming is still quite minimum. There's only been a 24 billion reduction in supply for 2025 versus 2024 in gross terms. I think it's interesting in terms of the demand story because I think that the ECB has been quite gradual in the way in which it's approached balance sheet unwind. So they've only gradually decided to, stop PSPP, so the public sector purchase program, and then they have another program called PEP, which is the pandemic emergency purchase program, and that has only gradually been unwound this year. And next year we'll see another leg up in the unwind of PEP. And I think that's an important component, right? Because the market has been used to the ECB acting as a buyer of bonds, and that big buyer has slowly but surely exited the market with the final step up in their roll-off really next year. So I think the demand story to me, at least for the long end of the curve, does look quite tepid. We're also seeing a shift in demand from Dutch pension funds, for example, who have historically been quite heavy buyers in the back end of the curve. So again, I think that supply story and demand story is quite weak for the back end. I think it's important to remember finally that this fiscal policy impulse is not contained to Europe, right? Brian and Imogen, you've talked about it as well. There's heavy supply across the world. And I think that is important for Europe because these rates are correlated. We're seeing an increase in US rates and an increase in gilt rates and a steepening of the curve. We do have some of that cross-country correlation at play here in the fact that fiscal policy and supply is elevated everywhere does matter as well for the narrative. So yeah, I think another year of heavy supply and another year of, I think, steeper curves in Europe as well.
Yeah, that makes sense. I think this kind of global impulse is important when we think about, where rates might eventually get to. Okay, before we close this out, let's just finish a little bit on politics because obviously we called 2024 the year of the ballot box and we're saying we're now in a kind of post-election world, which is half true because, we did have many, many elections in many, many countries this year, but there still are some elections to come next year. And I guess the political flashpoints or the warning signs are flashing most red in the euro area in the near term. We have German elections, you obviously have French risk. So let's go through those quickly one by one. Joann, you sort of alluded to it earlier, but German politics are really in the limelight. We have a snap election scheduled in February. What do you make of the risks here? There's obviously two risks I'm talking about. The first is the rise of AfD, the kind of anti-establishment or sort of far-right party in Germany, and how worrisome should that be for markets? And secondly, from a fiscal perspective, you rightly said earlier that, arguably Germany is one of the countries that could be spending a bit more. They've been fiscally frugal, but also to their detriment. Is this election going to move the needle when it comes to fiscal spending in Germany?
So, I think thinking about a snap election in Germany is quite different from France. I think many of us might get flashbacks to the last summer when we had that snap election in France and quite a lot of market volatility. But I definitely think that the situation is a little bit different in Germany. Coalition government is clearly the norm there. And whilst the AfD has risen in terms of their popularity, the key leading of the polls is from the conservatives, the CDU and CSU. And it's quite likely that they will be, will win the election and will have a coalition with other mainstream parties. So I would say I'm not as worried about the rise of the AfD. And I do think that it will be a mainstream government that it eventually does turn out to lead Germany. In terms of the second point on deficits, I think there's this clear story that
a new government might try to do something to shift the debt rules in Germany and to be able to spend more. I definitely think that's something that will happen with a little bit more spending in Germany that might come at the end of next year. But I definitely don't think that's a negative point. I think that's clearly an opportunity for more structural change and perhaps some more defense spending in light of lots of geopolitical tensions and clearly a Trump government as well.
And then finally, let's touch on French politics as well. As you mentioned, there's been lots of volatility in French bonds this year. But do you think next year could bring stability on the political front and therefore from a market's perspective too? Or are you still quite cautious on French bonds heading into 2025?
So I think I'd still be fairly cautious on France. There's obviously still a chance that we get another snap election next year. And I think there's also some concerns with Marine Le Pen and RN being taken to court for some, I suppose, misuse of EU funds. So I think that whole piece does bring a lot more volatility. There's clear questions about who would lead RN if Le Pen has to step down. There's clear questions about when's the right time for them to call another snap election because they do have to wait a year. So June would be the earliest point, I would say, where they would start to consider it. And I think the government really is quite fragile at the moment. So I think it's quite difficult for me to say anything positive about the outlook for French bonds next year. I think if you look at the deficit numbers and the debt metrics, they are also quite concerning. And if anything, the risks are skewed towards higher borrowing in France and elevated deficits being there for longer. So I think for France, to me, the picture's still quite negative into next year, and we are a bit more cautious on France going into the next year as well. I suppose we can't talk about politics without talking about a little bit more about the UK budget, Imogen. Clearly a sizable fiscal package, and markets did seem a little bit concerned about that. Do you think that the Labour government could U-turn perhaps on some of the spending measures over the next year, or perhaps in the spring budget?
Yeah, there's a couple of points I'd make here. I guess the first is that a lot of the decisions that have been made by this government over the last couple of months are aligned to their political ideology. So, it's, U-turns are going to be quite hard to come by in that sense. They haven't made a mistake. They haven't had unintended consequences with the policy measures that they've announced. This is, what fits with their, like I say, their political ideology. But there is a question, I suppose, over whether markets will kind of force a rethink or certainly a U-turn on some measures, whether that be spending cuts further down the line, whether that be more tax rises, just because the government left so little fiscal headroom in this budget in the autumn. And so the more that gilt yields rise, the more that market expectations of bank rate stay high, of course, the more that it wipes out that fiscal headroom. A couple of points I would make is just that we're not there yet, i.e. despite the fact that yields have risen quite considerably since the sort of pre-budget times, it's not enough to have wiped out all of that fiscal headroom. The OBR's projections show that they needed to see a 1% sustained rise in gilt yields and bank rate over the forecast horizon for all of that fiscal headroom to be wiped out. That's on the kind of investment spending measure. On the day-to-day measure, it was more like 0.6% of a rise in gilt yields and bank rate, but still a sustained rise through the forecast period that would wipe out the fiscal headroom. So we've got a bit further to go in terms of rate moves before you'd be really, really worried about that. Of course, it's sort of worth remembering, I guess, that from that perspective, it's less worrisome what happens in the early years of the forecast rather than what happens in the late years, because that fiscal headroom is defined as the difference between the fourth and the fifth year of the projections. And so what that means is that even if it were to force a U-turn, particularly on the spending cut side, that those spending cuts would just be delayed. They would be promised at the back end of the forecast horizon, and it wouldn't necessarily imply downside risk to today's borrowing. And of course, the final point I'd perhaps make is that, just as we saw in this budget gone by, it's not out of the question that should the government want to implement, spending measures that actually breach the fiscal rule that leaves them with no fiscal headroom, they could just change them once they started to bite. I mean, that's exactly what we did just see. The government changed the debt definition
in order to create more headroom, in order to borrow more. So it's not off the cards. It might not be a near-term risk. It might not be a 2025 story, but I don't think we could rule that out as we got closer to the next election, and the government had perhaps run out of space and kind of pre-election giveaways that they might usually look for would be harder to come by. Okay. So I think it's fair to say after all of this that, it's another year with plenty of risks ahead. I mean, this swing towards fiscal activism, global protectionism, and moving towards terminal rates is unlikely to come without, volatility and some periods of heightened sense of risk in the market. So I'm going to finish off by just asking you both the same question, kind of very quick answers. That what's the one risk that you think, when you think about the next 12 months, what's the one risk that you think is being underpriced by markets right now? Brian, I'll start with you.
Look, I think it's all about Trump. It really is all about Trump, because so much of what the market is pricing right now, so much of the moves we've seen in the last month and a half has been the market trying to handicap Trump, what we will actually get versus what we expect to get. The playbook, sort of the post-election playbook, has played out in a lot of cases. Stronger dollar, higher front-end rates, maybe a little less steepening in the curve than expected. But that's really the big one in the U.S. is if the markets are fully priced for Trump and Trump maybe under-delivers on tariffs or maybe on stimulus as well, that's going to have very meaningful implications for these forecasts. Similarly, if Trump is underpriced, these risks are underappreciated, that's going to have a meaningful impact both on the Fed and what that means for short-term rates and long-term rates. So feels like that's really the big question, is translating Trump from campaign into policy and trying to figure out where we are on that. Where is Trump priced in the market? Is he fully priced or not fully?
Yeah, that makes sense. And Joann, what about on your side?
I mean, Brian took the best answer, but I definitely think that for me in Europe, thinking about terminal rates at 2%, I think the big risk really is that we don't get an improvement in growth coming from Trump, for example, or just the fact that the European consumers are spending. So I guess the question for me is, do we actually end up with terminal rates at 1%, for example, if things don't materialize as we expect, versus the 2% that's being priced in by the market at the moment?
Okay.
Imogen, your turn.
For me, probably I would say it comes down to this bank rate view, and maybe it's not what markets are mispricing, but maybe it's the big unknown, is the impact of these measures that the government has announced, particularly when it comes to the national insurance contribution and how that's actually going to play out. Is that going to be inflationary? Are corporates going to be able to just pass that on to consumers? Or is that going to have an impact on the labor market? Are we going to see a bigger shakeout, a bigger labor market loosening than we have in our base case forecast? And ultimately that would allow the bank to cut rates, to lower levels than what we have in our projections. Or is inflation going to stay higher for longer and keep those rates ongoing? I mean, the other obvious one, of course, is that we think they're underpricing fiscal policy perhaps everywhere, but I think we've been through that in enough detail. So with that, I will stop there and just perhaps summarize by saying that I think it's very fair to say that the year ahead is looking no more quiet and no less volatile than in 2024. But we as Bondcasters, of course, will be with you every step of the way. We still got a couple of episodes left this year, I think, and then we will be back in full force in 2025, offering our thoughts and views on rates markets. So thank you both for joining me. Thank you to our listeners for listening in to our special extended year ahead episode. And we hope to see you soon. Thanks.